Of course, a dismal week to come in and talk about strategy because nobody seems to know what's happening on those markets and everything has gone pear-shaped this week. How do you read the markets this week and the negative factors that have led to this big pullback?
Well, it's clearly top of mind at the moment. But if I quote our commodity strategist Hussein Aladina, he's having a look at it and he spoke to a lot of clients yesterday. And typically, what you're seeing is a little bit of profit taking, perhaps, primarily because the fundamental drivers. I mean, oil's a great one, coming off $12 or $10 last night. The fundamentals are still in place. If we look at the global economy, it's forecast to grow at about 4.2%. And we've still got a deficit of about 500,000 barrels per day that we're expecting for this year. Now, if you had to reduce that growth to 3.2%, you would still be sitting with a deficit of about 200,000 barrels. So, in our mind, this is a bit of a pullback, bit of profit taking. We've had very stretched positions, so people are taking some money. But our view is there's still, it's still a good environment for commodities.
Do you think there's perhaps a bubble growing in some of those commodities, particularly silver and copper and oil, as you mentioned?
Look, silver's a difficult one because they increase the margining on silver, which obviously, impacts your performance that you can get out of it. So typically you're going to see some kind of pullback. And we've had spectacular performance in the last 12, 15 months out of silver. So, nothing goes up in a straight line. So I wouldn't be surprised about that. So silver, whether you can actually draw the parallel between silver and the rest of the commodities, hard to say at this point in time.
You said fundamentally nothing's really changed in the market, and yet we have had some pretty negative data coming out of the United States. Yep. We've had PMI numbers out of China this week, which were slightly disappointing, still positive, still above 50, but we're starting to see that monetary tightening in China taking a bit of an effect on the manufacturing sector. Does that change the demand outlook for you going forward?
Not necessarily. I mean, our emerging market strategist, Jonathan Garner, has been somewhat cautious on emerging markets, particularly his view being come June, come the end of the tightening cycle in China, which we expect to occur then you would start to increase your position in emerging markets. In terms of developed markets, our strategist there has been cautious for a period of time. So his basically thesis is that earnings will disappoint. We certainly saw in the quarterly earnings we've just seen, on average, 70% S&P beat it by about 7%. So it's typically about 3% ahead of the typical beat. So we're still seeing that, which would probably play into our thesis. Middle of the year, S&P 500 earnings slows down a little bit. Emerging markets gets towards the end of its rate hike cycle, and you move back into the emerging markets.
How about the South African market? Because following the pullback we've seen this week, we're actually negative on the year. So if you put your money in the JSE, you'd be where it was when you put it in December, wouldn't it?
Absolutely.
Do you think the South African market's now representing fairer value following the little pullback we've seen?
It probably is, but the work that we've done is typically, if you correlate the trailing PE, the price earnings multiple of our market versus inflation, 15.5 times or 15 times where we are right now typically infers an inflation of about 4%. If we believe that inflation is heading towards the 6% mark by the end of the year, then the market can derate to the 12 or 13. So that's basically in line. If you add in earnings growth rate of in the region of 20-25%, you could see plus minus 6 to 10% left in our market. So it's still not fantastically exciting, even though we've had the pullback, primarily because obviously the market's worried about inflation.
So do you expect then the JSE to continue trading sideways in the short term?
We would, and in addition to that, there are seasonal factors. The sell in May and go away. It actually does work. We've had a look at it repeatedly the last couple of years, and typically from the end of May till the beginning of November, the market generates about 25% of the return. The other months, 75% of the return. So it's a seasonally weak period as well.
So in that case, where would you be putting your money until November? You have to park it somewhere.
Well, look, we are overweight offshore, and I know, in the short term, it actually has hurt us. But what is interesting is that since the middle of March, you've seen about in the region of 30 billion rand of inflows. We had about 22 billion rand of outflows, portfolio outflows up to March. That's largely reversed, and we've got some inflows since then. So that's probably a cause of the short-term rand strength. I mean, certainly, I'm not an economist, but certainly in the short term, the flows do move the rand around. So for our viewpoint, we need 40 billion rand a year in order to compensate for our trade deficits and invisibles. So we've got about 8, we need another 30. Rand is quite strong, so we'd be expecting it to weaken slightly, not radically, but slightly.
Well, I know quite a big portion of those inflows have been into the bond market. Within the equity space, Where are foreigners looking, do you think? Where are they targeting for opportunities within our equity space?
Look, interestingly, we've seen a lot of excitement in sort of the more defensive plays, and you can argue that that's a very rational strategy with inflation coming up. So something like the telcos have seen a lot of flows. We've seen something like MTN has been getting a lot of demand. You know, MTN's done very well the last year to date. In fact, it's the best performing sector, the telco sector. So that kind of defensive play you can really understand, and that's where the foreigners are going. They seem still a little bit nervous about the retailers. Our own view is not a lot left in the retailers at the moment, and banks appears to be fair value rather than particularly exciting.
How about the resources space? Just given the commodity outlook that you're taking at this point, would you be seeing value in the resources sector?
We are. You know, we've got a large overweight position, Anglo's, Billiton, Sasol. As you would have noticed this week, it's hurt us. But we don't think it's necessary to change that view at this point in time. I mean, I was having a look at the earnings revisions. Sasol's had an earnings revisions. Their earnings are up about 15%, the consensus earnings expectations. So, you know, it's putting it on a very low PE. We're looking at sort of a sub 10 PE on a 12-month view. So, you know, we can expect some volatility around the oil price, but the earnings looks to be pretty good.
And if you were looking offshore, what sorts of sectors and what sort of companies would you be targeting offshore?
Look, I would have to play into the hands of our strategists, and we're looking at healthcare, very good earnings growth. The earnings is in the bag. They've taken a sort of a neutral energy, but they're staying away from the consumer stocks. So it's a bit more of a defensive position, but again, you know, relative to bonds and cash offshore, it's pretty much the only game in town.